You've seen it. A company blows past earnings estimates, the headlines scream, record profits, and the stock gaps up at the open. You jump in, convinced the rally will continue. An hour later, the price has reversed hard and you're staring at a 5% loss. What just happened? The market didn't misread the news, you misread the market. Trading is never about the event itself, it's about the gap between what was expected and what actually occurred. We dissect the event-driven strategy, how to exploit that expectation gap, the 3 core trading approaches, the confirmation signals that matter, and the discipline required when the market proves you wrong. Because events don't generate profits, reactions do. At its heart, event-driven trading exploits the difference between what the market expects and what actually happens. Before an earnings release, the stock price already reflects the consensus estimate. If the reported number hits that consensus exactly, the price often stays flat. But if the actual figure is far above or below, the price will adjust, sometimes violently. Your job isn't to guess whether the news is good or bad, it's to gauge the size and direction of the surprise. I rely on 3 tools. First, an event calendar. I mark every significant release for the coming fortnight. Second, consensus data. You need a baseline to measure deviation. Third, implied volatility. Watching for tells you how much uncertainty is priced in and hints at the post-event collapse that can be traded. Before you can trade the gap, you must measure it. The expectation gap is simply the percentage difference between the actual reported number and the consensus forecast. If a company was expected to earn $1 per share and reports $1.10, the gap is 10%. In theory, a larger gap should push the price further. But markets are complex. Sometimes a huge beat is already priced in, or the company's guidance disappoints. That's why you don't trade the gap blindly, you trade the market's reaction to it. This formula is your starting point for consistency, not a crystal ball. Over time, you can study how different gap sizes translate into price moves and develop your own edge. Event-driven trading splits into 2 distinct domains. The first is predictable events, scheduled releases where the date is known but the number is not. Earnings, central bank meetings, and employment data fall here. You can trade them 3 ways: position ahead of time, chase the move after the news, or sell volatility to capture the post-event crush. The second domain is black swans, unexpected shocks like a sudden war or a surprise sanction. For these, the only rational response is to cut risk immediately. Trying to pick a direction in the chaos is a recipe for disaster. Once the panic subsides and a new range establishes, you can re-engage with trend following or mean reversion strategies. The skill is knowing which type of event you're facing before you act. This chart shows the classic pattern of implied volatility around a high-profile event. 5 days before, sits at a calm 22%. As the event approaches, uncertainty drives it up, to 38% the day before and peaking at 45% on the day itself. Once the news is out, the uncertainty vanishes. Crashes back to 30% the next day and settles near 21% by day 5. This pattern, often called the volatility crush, creates a trading opportunity: sell options before the event and buy them back after. You're not betting on direction, you're betting that fear was overpriced. But beware, if the event outcome triggers a sustained trend, may stay elevated or even spike further, blowing up a short volatility position. For predictable events, you have 3 playbooks. The first is pre-event positioning. This demands an informational advantage. Maybe you've done proprietary channel checks indicating a blowout quarter. You build a position days ahead. If right, the gap is your profit; if wrong, the gap is your loss. The second is post-event chasing, which is my personal bread and butter. I don't try to guess the number, I simply observe how the market reacts. A big gap on massive volume in the direction of the surprise? I go with it. The market's collective judgment is often wiser than my own. The third is pure volatility trading, selling options to harvest the crush. It's a nuanced strategy that demands understanding of options Greeks and margin, so I recommend newer traders start with the post-event chase. I score each approach on how accessible it is for the typical retail trader. Pre-event positioning rates a 3 out of 10, it demands deep research, a high tolerance for drawdowns, and the stomach to hold through the release. Volatility selling fares even worse at 2, because it requires options approval, margin, and a firm grasp of gamma risk. The post-event chase scores a solid 7. You don't need to predict anything, you just need to read price and volume in real time. Capital requirements are modest, and stops are naturally defined by the gap boundaries. If you're starting out in event-driven trading, this is where you should focus. The post-event chase is my most used tactic, but it is worthless without confirmation. I look for 4 things. First, the gap must be significant. I filter using ATR, so I only trade moves that are clearly event-driven, not random wiggles. Second, the gap must hold. If a stock opens up 3% and immediately starts bleeding lower, buyers are not committed. I need to see that the new price level is accepted. Third, volume must confirm the move. I want to see at least double the recent average turnover. That tells me institutions are participating, not just retail momentum chasers. Fourth, I never enter at the first tick. I let the initial frenzy settle, wait for a stable pattern, and only then enter with a stop placed at the gap's edge. If the price returns to fill the gap, my thesis is wrong and I'm out. Not all gaps are created equal. To avoid trading noise, I use a simple ATR-based filter. I take the percentage gap from the prior close and compare it to the average daily range, adjusted for price. If the gap is less than 1.5 times the typical daily swing, I ignore it. The jump is within normal volatility and may not be event-driven. This filter alone improves your odds, but it's not enough. Combined with volume and gap stability, it forms a robust system. As with any parameter, the 1.5 threshold should be validated on your own data, because market conditions shift. A systematic approach replaces gut feelings with rules. This simulation illustrates why confirmation matters. If you trade every earnings gap blindly, your win rate sits at roughly 48%, not much better than a coin flip, and transaction costs eat the edge. Adding the volume filter bumps it to 55%. Then, requiring the gap to hold intraday pushes it to 62%. More importantly, the average win size tends to grow because the strongest trends emerge from these high-confidence setups. The message is clear: don't chase every gap. Wait for the market to prove itself. A disciplined approach to signal stacking turns a marginal idea into a genuine edge. Even a solid strategy can be destroyed by a few classic blunders. The first is sizing too large. I limit pre-event bets to 10% of my account. Beyond that, a single gap against you can be devastating. The second is paralysis under fire. Black swans demand immediate risk reduction, not a cool-headed thesis update. Your priority is survival, not analysis. Third, fighting the gap. If a stock gaps below your entry on heavy volume, don't buy more praying for a rebound. That gap represents a structural repricing, not a temporary overreaction. Fourth, disrespecting time. In options, the post-event 4 crush can erode your profits in minutes. And buying options ahead of an event is a trap. You pay for sky-high 4, so you need both a big move and the right direction just to break even. Avoid these mistakes, and you'll keep your edge intact. Events don't move markets, the gap between expectations and reality does. For scheduled events, choose your weapon: pre-position, chase, or sell volatility, but know your risk. For black swans, your only weapon is the exit. Live to trade another day. The post-event chase works because it follows the market's vote. Add filters, gap size, volume, stability, and you have a system. Discipline trumps prediction. In the face of an event, your opinion is worthless. Your stops and position size are everything. You don't need to trade real money to start. Open your economic calendar right now and pick one high-impact event next week: a major earnings release, a central bank decision, or a key economic print. After the event, apply the filters we discussed. Was the gap significant? Did volume confirm? Did the gap hold? Paper trade the post-event chase and track your results. Then come back here and share your findings in the comments. Let's build a community of traders who think in terms of gaps, not headlines. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.